Drawing trend line is something nearly all traders try to do in order to identify past and previous trends. Despite this, drawing trend lines remain hard to do for many traders. This is due to the fact that many traders have different conditions when it comes to considering if a trend line is valid. When this is the case, inconsistent trend lines are made, making the chart extremely cluttered and unclear. All of this causes confusion and incorrect trend lines, making it likely that entries will be made into losing positions. In order to avoid all of these problems, we can use an indicator that removes the elements of subjectivity, providing a clear and concise view of the trend and allowing traders to enter into profitable positions by filtering out the guesswork and noise in the market. The indicator we're talking about is the market bias indicator. Previously, I made a video about the market bias, which I'm gonna leave the link down in the description. But the market bias indicator is a powerful indicator that offers traders an objective and reliable approach to trend identification. Let's first add this indicator to the chart. But before that, if you want to trade crypto on one of the best crypto exchanges platform out there, I highly recommend to check out Bybit. It has one of the lowest fees out there, lots of good features. I talked about it previously, especially if you're a beginner. I highly recommend to watch my tutorial on Bybit, but it doesn't matter if you want to trade on other platforms, it's going to work out for you as well. The link for that video is down in the description. But if you want to take even more benefit out of trading on Bybit, you have a chance of winning up to $30,000 of a mystery box by just signing up into Bybit, and by using my affiliate link down in the description, you have an extra chance of winning an extra $5,000 worth of USDT, so don't miss this chance. All you need is just to sign up, do your KYC procedure, deposit at least 100 USDT and start trading on it. Head over to the indicator search tab and search for the market bias indicator. Select the indicator made by Professor X and add it to the chart. This is the market bias indicator, an indicator that helps determine the market bias and the overall direction of the market using a combination of moving averages and smooth Heikin-Ashi candlesticks. Along with this, there are different colors that are plotted on the market bias ribbon. Now let's change the indicator settings. Navigate to the indicator setting tab and click on the input tab. The first setting we can see is the period setting. The period refers to the length or duration over which the indicator calculates its value. It determines the number of data points considered in the calculations, thereby influencing the sensitivity and responsiveness of the indicator to price fluctuations. By increasing the period value, the sensitivity of the indicator is lowered, showing us a longer-term view of the market bias. On the other hand, when the length is decreased, the indicator becomes more sensitive to changes in the price action, causing the indicator to show a shorter-term market bias. Since we want to decrease the sensitivity and see stronger and long-term trends, we will be changing this setting to 150. Next, let's discuss the smoothing setting of the market bias indicator. The smoothing value determines the smoothness of the indicator's calculations. It acts as a filter to reduce noise and clearly represent the underlying trend. A higher smoothing value, such as 200, would result in a smoother indicator line, reducing short-term fluctuations. Keep in mind that while this means the indicator will provide a clearer view of the market bias, it causes the indicator to become less reactive, making the reading it provides less precise. Conversely, a lower smoothing value, such as 20, will provide a more responsive indicator line, capturing faster changes in the price action at the cost of increasing the noise displayed by the indicator. A good middle ground for smoothing is 50, showing us a smooth and clear view of the trend without including too much noise. The final setting of the market bias indicator is the oscillator period. The oscillator period determines the length over which the indicator calculates the oscillating values, which indicate the strength of the trend. By adjusting the oscillator period, traders can fine-tune the sensitivity of the indicator to market fluctuations. A shorter oscillator period, such as 3, will generate more frequent signals and respond quickly quickly to price changes. Conversely, a longer oscillator period like 30 would provide smoother and less frequent signals, capturing broader market trends. Since we are looking for a middle ground, we'll be keeping the oscillator value at its default value of 7. Now that we properly configured the input settings, let's navigate to the style settings. Here we'll be removing the Heikin-Ashi candlesticks since the line already reflects the value of Heikin-Ashi candlesticks. That was all we needed to do. Now let's learn how to read the indicator. It's first important to understand how the indicator can be read. We can first look at the position of the market bias line and compare it to the price action. When the line is above the price action, it indicates that the trend is bearish or likely to switch to bearish. However, if the price is trading above the market bias line, it indicates that the trend is bullish or likely to switch to bullish. The second component we should look at is the market bias line color. Obvious that whenever the line is green, it indicates that the trend is bullish, and whenever it is red, it indicates that the trend is bearish. However, what exactly do these dark green and dark red colors mean? When the market bias line is light green, it indicates that the market is in a stronger bullish trend. An example of when this would be the case is if a bullish breakout occurs. On the other hand, a darker green color indicates that the bullish trend is weak. An example of when this would be the case is if a pullback or a correction is made. When the market is in a bearish trend, the indicator will display either a dark red or light red color. When the color of the indicator is light red, it shows us that the bearish trend is stronger. This cloud occurs, for instance, when the significant bearish breakout takes place, indicating a strong selling pressure. Conversely, when the market bias indicator displays a dark red color, it suggests a weaker bearish trend. This might happen during a pullback or temporary consolidation within an overall trend. Now that we know how the indicator can be read, let's take a look at the different methods of using the indicator. Besides the regular method for reading the indicator, which involves looking at its color, the Heikin-Ashi calculations in the market bias indicator can also be utilized as support or resistance levels. It often happens that pullbacks are made to the market bias line before heading back in the bullish direction. The same goes for bearish trends, where there are many instances where the price pulls back up to the market bias line before heading back down in the bearish direction. A different method for reading the indicator that can be used to spot and avoid ranging or consolidation markets involves looking at the width of the market bias line. The indicator line becomes wider when the market is consolidating. This can help us spot and avoid these consolidation and ranging phases in the market. Conversely, the market bias line will be thinner when the price is heavily trending. By looking at the width of the market bias line, we can easily determine whether the market is trending or not. Let's have a quick pause here. I've got some comments and reviews previously. I've heard it from lots of traders that they say, all right, the indicators, these strategies, they don't work in range market. Let's make it clear once for all. It's not about a trading strategy. It doesn't matter if you're using an indicator-based trading strategy or you're using something like the pure price action using not any indicator at all. You should not trade when the market volume is low. So there is a big difference and there is a big gap in definition of a ranging market and a consolidation phase, or let's say low volume market. Let's make an example. Imagine that you have a 1 hour time frame and the price is ranging. If you step it 2 times down and go to 15 minutes time frame or even lower to 5 minutes time frame, then it becomes a trendy market. So this is the same market, same asset, same pair, but different time frames. So is it a range market or is it a trending market? The fact is that whenever you focus on one time frame, when you see the low volatility in the market, you should not trade at all. Or if if your trading time frame is already high, for example, like higher than 1 hour, you can just step down, and within that low volume phase, you can find some trends in lower time frames. You always have to trade multi-time frame. In the near future, I will make a video about that, but that's all about it. Forget about the fact that you tell yourself that this or that strategy is not working in a ranging market. It's not the ranging market. It's the low volume, low volatility, or let's say the consolidation zones, which it doesn't matter what the strategy you choose, you should not trade in these phases, because market makers can come and they can make some, crazy moves in the market. So first you must wait for the market participants to drive the market in a certain direction and then start trading. By adding 2 market bias indicators to the chart, each with different settings, we can see both the short and long-term trends. This allows us to enter into positions when both the short-term and the long-term trends align. Adding indicators to the chart can create a full strategy that utilizes the market bias indicator. Despite the indicator already being very powerful, we will be adding some extra indicators to the chart in order to create a full strategy that utilizes the indicator. Head over to the Indicator Search tab and search for the Range Filter indicator. Select this indicator made by this amazing scripter, thanks to him or her by the way, and add it to the chart. The next indicator we will be adding to the chart is the Volume indicator. Search for the Volume indicator and select the indicator which is made by TradingView, or let's say the standard version. Those were all the indicators that we'll be adding to the chart. Now let's change the indicator settings. First, navigate to the Range Filter indicator setting and click on the Style tab. We'll be removing the high target, low target, bar colors, and all other elements except for the buy and sell labels. Now let's head over to the Volume indicator settings, click on the Inputs tab, and here we will be changing the length of the moving average to 35. Once you have done that, click on the Style tab in order to enable moving average. Make sure also to change its color to your own taste and make it more visible to your own eyes. In order to enter into positions by combining these indicators, we will be using the following method. First, we will be determining the dominant trend with the market bias indicator. Next, we will use the range filter indicator to determine the exact point at which we will enter into the position. Finally, to confirm that there is enough volume in the market, we will be using the volume indicator as the final confirmation. Let's take a look at entries that can be made by following this method. Here we can see that the market bias line is green, indicating a bullish trend. This pullback serves as a natural reaction to the bullish surge, creating a correction causing a temporary pause in the market's upward momentum. To gather more insights, we turn our attention to the range filter indicator, which also issued a buy signal, reinforcing the notion that the range filter is currently bullish. This additional signal aligns with our previous observations, further support the idea that the market has the potential to resume its upward trajectory. Moreover, we noticed that the point at which the price began to reverse its direction had previously acted as both a support and resistance level. This historical significance lends more weight to the current price movement and suggests that the market sentiment could favor in a continuation of the bullish trend. Finally, if we take a look at the bars that were displayed on the volume indicator, we can see that they exhibit a bullish pattern sentiment and are positioned above the moving average. This observation underscores the presence of a significant amount of bullish volume in the market, indicating that there is enough buying pressure to potentially push the price higher. By combining all of these signals, we can conclude that it's a good idea to enter into a buy position. To manage our risk, we will be placing our stop loss at the recent swing low, aiming to limit potential losses in case the market doesn't follow our anticipated trajectory. For the take profit level, we will be adopt a risk to reward ratio of 2 to 1, seeking to secure a reward that is twice the amount we are risking. This approach allows us to maintain a favorable risk-to-reward ratio balance. Here we can see that price made a pullback to the market bias line. We can see that the market bias line was still green and moving in the upward direction. After the pullback, the range filter produces a buy signal, providing confluence with the signal provided by the market bias line. The final signal that confirms the previous signals provided by the market bias and the range filter indicator is provided by the volume indicator. We can see that the volume indicator is indicating that there is enough bullish volume in the market due to the bar being taller than the moving average. Because of these signals, let's enter into the buy position. We'll be placing the stop loss at the most recent swing low. For the take profit, we will be targeting at 2 times risk to reward ratio. So you can just give it a try for the short trades, and the rules are the same. All you need to do is to make the rules the opposite the way of the long trades. I hope you now fully understand how the market bias indicator works and how it can be used, integrated into your own strategies. If you enjoyed the video, please leave a like and subscribe to the channel and share this video with your friends. Stay tuned for the upcoming videos though. Thank you so much for watching. See you in the next one.